What costs qualify? The supplies category of expenses is very specific with regards to what can and what cannot be qualified. There are 4 different types of supply expenses that qualify for the R&D tax credit. There are raw materials and consumable supplies used to produce prototypes, pilot models, first articles, and/or samples for validation. Then custom equipment and equipment components that we design, develop, and create. Let's look at what that means. At our facility, we create ballpoint pens. This year, we created a brand new ballpoint pen that is the most cutting-edge pen that we have ever created. Our first effort included development of a brand new barrel and tip. Initial prototypes were created in our lab using a 3D printing process. Then, we developed brand new equipment, tested the equipment by producing small batches of the pens and making adjustments to the process until it met our quality standards. In this scenario, the cost for the prototypes, including the raw materials and consumable materials utilized in development and testing, would qualify. In addition, the raw materials to run the initial small test batches would also qualify. Finally, since the equipment was completely created by our company, the cost of that equipment would qualify as well. One thing to note, when qualifying a piece of custom equipment as R&D equipment, it cannot also be depreciated. Computing expenses encompass the cost for all expenses relating to computing needed for development. Costs such as cloud hosting, costs related to development environments can be qualified here. If you click Add Expense, you will see fields for vendor name, vendor description, amounts paid, and R&D allocation percentage. Since expenses aren't always differentiated in accounting systems, you will be able to take a portion of each line item so that the final qualified amount will reflect the actual costs associated with development. What costs qualify? Computing expenses are a holdover from the early 80s, when companies needed to pay for computer time to do much of what we do today from our laptops. Since then, the nature of this expense category has changed to encompass a lot of costs that startups share across many industries. First, there are cloud hosting costs. Then there are costs relating to data connections, platform providing development services, code management, and even digital assets. These types of expenses can be captured within the computing expenses category. Here, we see the subcontractor screen. Like all the previous sections, we start with the vendor name. Then, regardless of where the actual vendor is located or where the invoice is sent, subcontractors should be attributed to the state where significantly all of their qualifying activity physically took place. For instance, if you hired an engineer who lived in Utah, but that engineer traveled to your facility in Nevada to do all their work, the state listed should be Nevada, as this is where the development activity occurred. These considerations focus on who is at risk for the development being performed. Agreements with subcontractors performing qualifying activity need to be structured as hourly, time and material, or cost-plus type agreements. If a contractor is performing development work for you but is being paid on a fixed fee, fixed scope model, these expenses do not qualify. The only exception to this rule is if the contractor is conducting testing for development purposes, but do not also propose solutions for any problems that might arise. What costs qualify? Generally, qualifying costs for subcontractors would include any time spent of qualified activities. Essentially, it is the exact same criteria that we saw for the wages section. If the subcontractor is performing technical planning activities, such as defining requirements, developing specifications, creating, modifying designs, coding, conducting tests, and/or developing manufacturing processes, the costs associated with those activities would qualify.